Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris McIntire. McIntire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning with our money, for our finances, and our retirement future. He's president and founder of McIntire Retirement Services, Chris McIntire, helping us have the information to make sure that each and every dollar is working its hardest to help us achieve our financial goals. And one of those goals that I'm hearing a lot right now, Chris, is I just don't want to lose any more money. A lot of people seeing losses in their portfolio, not really happy about that.
Yeah, Peter, and let's call 2022 so far the year of unfun. And, some of that delivered by a normal market correction that is, it normally happens anyway. And then we have a Federal Reserve that's been aggressively raising interest rates, and that has depressed the bond prices there to start the year off, at least through the first quarter and leading into the second quarter here as they try to kind of normalize interest rates and also to bring down the cost of inflation. So, I would say no gain, no pain, probably not the other way around, but, try to catch up with where inflation is. And, we could criticize or second guess all of this here, and it doesn't make any difference. When we pull up to the gas pump, we still have to pay the price right now. And, inflation is hard on everybody this year. It hasn't left anybody unscathed.
Yeah, a lot of different forces and factors there, Chris. But I heard you mention or allude to the fact that volatility and losses in the market, they are actually more normal than I think we would like to think. And in fact, the lack of volatility that we have seen over the last decade or so really has been the abnormal kind of thing that has happened. And volatility is a regular part of the market environment.
Yeah, it certainly is, Peter. And through the COVID pandemic, we had so much extra money or, boost stimulus delivered by the federal government. And, we've had a very easy monetary policy with very low interest rate environment that has, fueled a lot of this economic growth. And we knew it couldn't go on forever like this. We had very low interest rates. And I believe in 2018, the Federal Reserve had raised interest rates 4 times. And again, that was a year we, had a lot of negative asset prices for that year in all different asset classes, stocks, bonds, commodities, basically everything in 2018 was down, more so than any other time in, let's call it market history. We had more negative asset classes. 2022 so far, bonds have been down, stocks have been down in general, but the real estate market has been up and commodities have been up. So, little different feel for it than we had in 2018, which was another year of, kind of disappointing investment results. No question about it. And it happens, that's part of an economic cycle. That's why you invest according to your risk tolerance, you rebalance on a quarterly basis, and you have safe money as an alternative so that you can put your head on the pillow at night.
I do want to talk about those safe money alternatives for those who may not like the losses that they are seeing in their portfolio or the volatility of the market, or would like to explore other options that can help protect the life savings that they do have. There are those options out there. And if you'd like to find out about how to properly allocate your portfolio to meet certain goals and objectives to make sure that you are on track toward meeting those milestones into your financial future, pick up the phone and give Chris McIntire a call at McIntire Retirement Services, 800-868-1194. That's 800-868-1194. But Chris, you mentioned kind of the easy monetary policy, all of the stimulus money that was created. quantitative easing after the Great Recession, the COVID relief packages after coronavirus. Grandpa used to say, eventually you have to pay the piper. Is what we're seeing now sort of the results of that easy monetary policy, as you put it, over the last 10 years or so?
Yeah, that'd be a good way to describe it. And, probably a Federal Reserve that came to the game a little bit late on the inflation side. A lot of discussion. Again, we can all say, hey, we should have, right? Should is a very punishing word, but, perhaps the Fed should have raised interest rates earlier to get ahead of inflation. So a lot of people say they're chasing after it now, trying to get in front of it. And, if you ever watch a race on TV or something, it's a lot harder to pass the car in front of you than it is to drive away from them once you're in front of them.
Yeah. So again, we've got to consider what our options are here carefully, because these adjustments in policy by forces outside of any of our individual control actually impact all of our individual money and each and every dollar that we have. So it is creating a little bit of turmoil, volatility in the market, the Fed's announcements, the news, the forecast of what they intend to do in the future, coupled with many additional forces outside of our control. But we can take personal control over our individual dollars, Chris. And you mentioned that there are alternatives out there, and wanted to talk a little bit about those. If somebody does not want to risk money in wide swings and market fluctuations, is their only option to sit it in a bank and get next to nothing interest, or gather dust in the under the mattress?
Well, that's probably a good starting point for this conversation is, the traditional banking instruments of checking, savings, money market accounts. And you're going to start to see those rates go up here a little bit as they've raised interest rates, twice already by the time depending on when you listen to this radio show, because it's available on our website as well. But let's call it here in the early part of the second quarter here of 2022. You'll start to see interest rates come up on some of those savings accounts and money market accounts, but CDs, some of those things are a long ways away from, even being competitive with the inflation rate, Peter.
Yeah, they tend to lag behind much more so than, say, mortgage rates, right, Chris, which almost preceded the interest rate announcement from the Fed in going from 2% to up to 5 to 6% or even higher.
Yeah, Peter. And, they want to get paid first and then pass on some of those earnings. I think if I read into your analogy there just a little bit, you're right.
Seems so.
They've raised the borrowing cost a lot faster than they raised the savings interest rate payments. And, it is what it is, right? My dad would call that the golden rule. He who has the gold rules.
Mm-hmm. And so again, maybe for right now, the anticipation is that hopefully into the future at a certain point in time, once again, we will see some kind of reasonable rates for bank style accounts, checking, savings, CDs, money markets. But for right now, those aren't providing us with a whole lot of advantage or a whole lot of growth, Chris. So what are some of the other options if we don't choose to or do not want to take the risk of stock market style investing?
Sure. Yeah. So the traditional banking, isn't in favor right now. Traditional banking instruments transition into what do insurance companies offer, right? They compete a lot with the banking industry on, call them safe money alternatives, if you will. Got to use the right right terminology here, Peter. So, banks or insurance companies offer fixed annuities that pay a fixed interest rate. And, as the bond interest rates have creeped up, or you hear that term, yields on 10-year treasuries are above 3%. That's very good for an insurance company who buy a lot of 10-year treasuries. So, when they were 1.6 is one thing, when they're 3%, that's basically 100% increase in the interest rate environment, which means, hey, they can pay out more on those fixed rate annuities, and we'll probably be doing a fair amount of them going forward. And they come in all different shapes and sizes, from 2-year to 3-year to 4-year to 5-year to 10-year. State of Ohio, you can't have an annuity that's longer than 10 years.
Well, if you are interested in what could I earn on the safe money, ladies and gentlemen, a 2-year fixed rate, 2.6%, 3-year, 3.25, 4-year, 3.3. You can get up to about 3.7 for a 5-year fixed rate. Chris, in all, in this interest rate environment, those aren't bad rates for that kind of period of time.
Yeah, you're exactly right. And, thankfully they are backed by the claims paying ability of the insurance companies, which is nice to know. And that's why they get rated and things like that. And
then once again, by the time somebody hears the show in this interest rate environment, Chris, those rates could change, but given the direction of the current environment, probably, at least for the short term here, only improving, if anything.
Yeah, exactly. Yeah, we would certainly see that trend upward versus downward, Peter. I think you're right there. And, but some folks listening to the show right now might say, I'm not really, I got inflation at 6. Why do I want to make 3? So the other side of that annuity space from the fixed rate annuity, or what we call a multi-year guarantee, which, a 5-year CD pays interest rate for 5 years. A 5-year multi-year guarantee annuity pays interest for 5 years as well. And you can get that same interest rate. We call that multi-year guarantee annuity. Insurance companies have also, in the mid 1990s, to help compete with, bonds and whatnot, came out with fixed index annuities, where your earnings are linked to the performance of a stock market index. And we have seen that earnings potential increase as the interest rate environment and yields are also increasing as well. So some very good opportunities, to, make a competitive rate of return with your earnings linked to a stock market index without directly participating in that index. So, you have zero downside where you can't lose your principal. That's why we call these safe money positions here. Now you might have a surrender charge, that sort of thing, if you exit the annuity early. So, but that's a voluntary loss that they say, hey, I'm leaving here early. If you stick with it over the course of time, you could certainly take advantage of some favorable stock market conditions and participate in some of the growth of that without the downside. Many of them do not have any fees attached to them whatsoever. That's the trade-off, is time. You've given the insurance company 5 or 7 years on an index annuity is very common. 10 years is very common. Some of those also have income elements that if you wanted to create a lifetime guaranteed income that can even increase with the growth of those indexes to help you combat with inflation. So some very clean, productive, strong potential out there on the index annuity space. We've been using these things for over 20 years, so we know them fairly intimately. And, I hate to, some folks may have a bad taste because of a commercial or something along those lines, but they have made significant improvements in this industry. And, and unlike your bond investments that are down in value, your index annuity doesn't lose anything. So, there are some other alternatives that can make up a piece or a portion of a retirement portfolio, certainly not all of it.
Yeah, well, again, if you'd like to find out more about how to get safe rates of growth into the future, give Chris McIntire a call, 800-868-1194. That's 800-868-1194. You kind of ask the rhetorical question there, Chris, why would I want to put money away at 3.5% when inflation is at 6? But let's look at some of the common alternatives. I mean, at the end of April, and as of the recording of the show here, kind of in the first part of May, bank rates were still less than 1%, 0.5% or less on checking, savings, CDs. The Dow Jones ended April down about 9%. The NASDAQ ended April down about 21%. The S&P ended April down more than 13%. And again, some claw back here at the beginning of May, but that's day to day and fluctuates. So a locked in 3 to 3.5% rate of growth, Chris, given those alternatives, or something that gives me the opportunity to share in the gains of the market with no risk, no cost, no fees seems like a pretty reasonable alternative.
Yeah, it certainly does. And, we've been utilizing the fixed index annuity space, some of the real estate holdings as well to, try to mitigate all that direct bond exposure to this interest rate cycle we're in. And, it's worked very well for us. We have to watch the liquidity needs and whatnot of each individual client. But, when you use the correct tools and the correct methods in the correct spots, it's a win-win for everybody that's involved out there. And, let's be realistic. You can talk to 10 different people and get 10 different opinions. I know what works in what we do for our particular clients. But if you walked into, maybe another entity that they might not have the independence that we do, as an independent investment advisor, they may have a different take on it. Or if you watch a couple of selected TV commercials, they may say, I say this sarcastically, it might not fit their business model, so they disparage it, and that's doing everyone an injustice.
Well, I think it's just all about the education, understanding the different options that are out there, and being able to then reasonably assess pros, cons, advantages, and disadvantages. And that's the process there at McIntire Retirement Services, talking about your goals, your outlook, and then what tools, what options can help work and help your dollars work to help you achieve those goals into the future. A realistic, fair assessment of those options, and then helping to select which is most appropriate. Give Chris McIntire a call if you'd like to get a better understanding of what you're seeing on your statements, of what you currently own, the risks that you are exposed to, the fees that you're paying, as well as what options are out there to help you control your risk, protect principal, protect income into the future, to work through many of the biggest financial tools that we have available to us, how to maximize and optimize Social Security, how to control your tax liability in the future. These are all the conversations that Chris McIntire has with his clients across Northwestern Ohio each and every day. If you would like to have an introductory conversation and an intro review and strategy session, no cost, no obligation, just pick up the phone and give a call. 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, you've mentioned these real estate tools a few times. The outlook for those, the outlook for real estate may be a little in flux as interest rates are changing this year pretty dramatically. But these are tools that have a lot of different elements, different angles into the real estate market, something that you are helping people understand where there may be opportunity in real estate inside of a traditional investment portfolio right now. I always think that that's one of the biggest impediments to real estate, is that you've got to come up with a huge sum of money or either borrow that money and then find an actual physical location to get into real estate. That's actually not the case. There are plenty of ways to get into real estate inside of a more traditional investment or retirement portfolio.
Yeah, that's a good point to bring up, Peter. And, and as you and I sit here and talk, I try to put myself in, if I'm a listener, how do I picture this? So when we say real estate, we're not talking about the rental property in the next block from you or anything like that. Not that there's anything wrong with that. We're talking of it more on a, something coming out of the Wall Street side of things, yeah. A real estate type mutual fund that might invest in medical buildings, might invest in manufacturing facilities, maybe also in apartment buildings. So as Peter brought up that, as interest rates go up and housing prices have also gone up, it prices certain people out of the market, which makes apartment buildings that much more valuable because people are going to be in there longer paying that income. And the return on these types of real estate pieces that Peter and I are referring to are really tied to high rates of occupancy that people are paying rent. They pay that rent back out to, owners of the mutual fund, if you will. And again, there are a lot of different ways to do that. Some of you may be familiar with what are called real estate investment trusts. Yeah, REITs. And, if we use a REIT in our practice, we use one that is publicly traded, that just like a stock, for example, Welltower in Toledo, Ohio is a good example of a publicly traded REIT. And they're just a stock, they're like buying a stock, and then they own lots of different types of medical buildings. That is their modus operandi, if you will. There are other real estate investment trusts that are sometimes sold through the brokerage world, and you have to hang on to them, and they're not very liquid. And we are not in favor of non-tradable REITs. We like tradable REITs that you can get in and out of when you want to. And then we use a couple of different real estate type mutual funds that have quarterly type liquidation set up. So that's why they call those alternative investments, Peter. And some of those you're not going to see in your company and sponsored plan. But, right now, the hottest part of the commercial real estate market is not office space. It's not retail space. It's more along the lines of the apartment building complexes. And I mean big complexes, not talking about, here's an apartment building with four units in it. We're talking 400 units maybe. And then also manufacturing facilities, as the economy is hot and companies are looking to build, especially in that biotech space where they need, creating this new science. That is a very hot market space in the real estate world right now. And because for them, it's hard to adapt an old building. They need a new building that they can put all the clean ventilation, all the new HVAC and all that stuff. And then they may rent that for 25 or 30 years out of the gate. So, taking advantage of some of that. So that's not real estate in the sense of, if you're listening to the show, buying a couple of rental properties and fixing the sink on a Saturday. That is, trust me, that is not my thing whatsoever. And I know how to fix sinks, but it's not something I would personally want to do. Nothing against that. If you're a handyman and you like to tinker and you need something to fill your time with, hey, fantastic.
I like that you acknowledge nothing wrong with that style of real estate exposure, but also, Chris, as always, picking up new information every program, great education, that there are other options. There are other ways to go about this if you would like to begin to or add that exposure into your financial life and your investment portfolio. Real estate, a great asset class, and there are ways to access that within the investment portfolio, ladies and gentlemen, and they're actually numerous. There are many different ones, and you can tell through this program and through Chris's explanation there that not only does he understand it, he digs into the details. He wants you to understand it as well. So if you'd like to have that better understanding of these choices, of these options, of these non-correlated type of asset classes that can provide you with a good overall picture and allocation, pick up the phone and give a call. Chris McIntire, McIntire Retirement Services, your resource, Northwestern Ohio. You can speak with him personally and individually about your financial situation, your financial goals. 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, as the financial world has really become increasingly complex over the decades, do you think that it has become more important that people pick up on some of these additional types of investments and asset classes, like the principal protected options, like the income protected options that you discussed, like the real estate kind of exposure options that you have discussed, that it becomes important to educate ourselves and potentially include those for our overall financial health?
Oh, absolutely, Peter. And we do our educational courses around Northwest Ohio, and they are centered on educational pieces. And we'll update you as we do those on the radio show here, folks. We don't have anything set up over the summer months just yet, but taxes are going to change. We have legislation that's pending that changes. We have interest rate environments. We have lots of different challenges in many different areas to combat those challenges, to mitigate risk, to build diversified portfolios based on the individual we're talking about. And then instead of a cookie cutter, one size fits all, we just make one little adjustment this way or one little adjustment for everybody, is not what we do.
Well, again, if you would like to have a resource, have a relationship with a qualified, experienced advisor and planner, pick up the phone, give McIntire Retirement Services a call. If you'd like to review some of the current accounts and statements that you are seeing to see if there's anything that could work better to help you achieve and accomplish your goals, Chris McIntire is that resource. Give a call, 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, one of the biggest tools that most Americans have is the 401k or employer-sponsored plan. We mentioned it on last week's show, but always bears repeating that most people actually are not aware that at 59 and a half, in the majority of these plans, we are actually given the opportunity to take more control over our money, maybe go a different direction with the current life savings that we have built up to that point, but continue to contribute and take advantage of the plan with new dollars and contributions on an ongoing basis thereafter. Can you talk about that important in-service distribution and why that may give us the opportunity to take advantage of some of these other options you've discussed?
Peter, we've done a lot of that this year with clients that are currently working that are over the age of 59 and a half, and to help them protect some of their money that they don't have some of the options that we were talking about today on the show within their 401k plan, but also telling them that, look, continue to make those contributions. I've had a lot of folks ask me, hey, should I be putting with the market being down, should I just put my contributions into more of a safe piece? And I say, and depending upon who the client is, Peter, I may say, look, continue to buy stocks right now because the market's down. This is when you want to buy stock. You don't want to throw it into cash and wait for the market to go up and then start buying at higher prices. So depends on who they are, but we certainly help people at that 59 and a half threshold. It's a very key part for our business to help them do pre-retirement planning and get into and broaden their horizon on the options they have, where they want to place some of their life savings for their eventual retirement, buddy.
Well, again, you've got to understand the options that are out there. You've got to plan strategically for how to utilize them, evaluate whether or not they are appropriate for helping you achieve your financial goals. That is the process that the trained eye of an experienced, qualified professional can help you work through and come out on the other side more informed and therefore confident about your money and about your financial progress. That's the resource that Chris McIntire and McIntire Retirement Services is, ladies and gentlemen. Pick up the phone and give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Again, Chris, one of the advantages of working with a qualified, experienced professional with that trained eye, you really can help people spot and identify where they may have overexposure to risk or underperforming assets in their current portfolio, things that sort of are low-hanging fruit that can actually pretty easily be fixed.
Yeah, absolutely. And, spot some of those holes and some of that, look at Roth IRA conversions, if you will, overexposure to certain stocks and whatnot also.
Great point, Chris. We talked an awful lot about that Roth opportunity and Roth conversions last year. That door has not shut. That window has not closed this year. Again, I would imagine you are probably still proactively and ongoing helping clients to manage the lifetime tax liability and reduce that wherever possible. Roth conversions, still an opportunity we need to be paying attention to.
Absolutely, buddy. Yep. Happy to help. And it's nice when we get to educate our clients, and, we're an independent fiduciary, as it should be.
Well, ladies and gentlemen, if you would like to address questions or concerns, if you would like to have that portfolio review and evaluation, understand the risks that you're taking, the fees that you're paying, the taxes that you may be liable for, and control those things, pick up the phone and give Chris McIntire a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Go online, McIntire Retirement Services.com. Chris, always a pleasure to have you here on the program, and we appreciate the guidance, perspective that you provide.
My pleasure. I hope everybody has a great weekend out there. Stay safe, and thank you for listening today.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.